All right. Hello, everybody. Thanks for joining us for our inaugural Insights and Outlook webinar. My name is Mike Scarsciotti. I lead our investment strategist and practice management insight team. We're very fortunate to be able to bring the best of what Fidelity has to offer from a thought leadership perspective and an investment perspective from across all of our asset management divisions to all of you, our clients. We're here today to talk about our outlook for the fixed income markets in 2026, and I'm joined by three of my colleagues, who I'm very excited to introduce. But before I do that, I just want to do a few housekeeping items. First of all, we'd love for you to all know that there are lots of resources that you can access. We've put several of those through the resource button at the bottom of your screen, so feel free to explore that as well as on our broader website, institutional.fidelity.com. So as I mentioned, this is the first of many bi-weekly webinar series that we'll be doing. Many of you, looking at the attendee list, have joined us for prior webinars and thought leadership events in the past. This is really an attempt to make sure that we bring the most timely and thoughtful insights from Fidelity to all of you as you're trying to help your clients with the investment decisions that you face. With that, I won't take up any more time because we've got a great panel here for the next 28 minutes. I'd like to turn it over to Brian Donnelly, who's our lead fixed income strategist here within Fidelity Institutional. He's joined by two of our fixed income portfolio managers, Celso Muñoz and Brian, who are really going to go deeper on what it is that we're seeing in the bond market today and what we're looking at for 2026. So with that, I will turn it over to Brian. Thank you.
Thanks as well for everybody being here on Fed Day, right? We knew that when we put this together, but we've got some very fresh things to talk about when we get to that point in the discussion. Thank you very much for your pre-submitted questions. We've tried to weave them into the dialogue here, so I'll jump right in with a layup. Celso, a lot of press about how bonds have lost their negative correlation. Do bonds still work today?
Well, thanks, Brian. I think the short answer is yes. And I think it's important to take a look and see what was it that drove all the headlines around that correlation benefit breaking down. And what drove it is that shortly after the pandemic, in the fall of 2020, the bond market was yielding 1%. Yields really went down. And when you've got a bond market that's yielding 1%, it just can't do much for you. It's not generating much income, and there's not much cushion there. There's not a lot of upside. Remember, if yields go down, bond prices go up. At 1%, there's not much room for yields to go down, and so you were left with a scenario where they just couldn't really provide that diversification benefit. We went through the period of 2022 with rates increasing dramatically. We called it the great rate reset of 2022. And what you were left with afterwards was a bond market that had a lot of yield. We went from being at a 1% yield to close to 5%. We're closer to 4.5% today. But with that level of yield, the market can produce that diversification benefit. And in fact, if you look over the last couple of years, when we've had really big events of volatility in the market with big equity drawdowns, in many of those, if not most of those scenarios, bonds have actually helped you. Just take a look back at the regional banking crisis, and you'll see that bonds helped offset some of that equity drawdown. So they were delivering on what they're supposed to deliver. Now, I would just take a step back and think about the market overall right now and see where we stand. Given that yields are as high as they are now, they're actually near the highs of the last 20 years. That puts the bond market not only in a position to deliver that correlation benefit that you're talking about, Brian, but I think in most scenarios, the bond market can deliver a positive return, which is what it's done for the most part historically. There have only been 5 calendar years where there's been a negative return. So I think we're going back to more of a normal type of environment from a return perspective for the bond market. And so what that does is that most of the return now in the bond market is driven by income. And that means that even in some scenarios where prices go down, if you give it 3 months, 6 months, 12 months, there's so much income being generated that at the end of that time period, you're very likely to be back at a positive return. And in fact, our risk models would suggest that something like 75% to 80% of all the market scenarios that we look at, and we look at something like 5,000 scenarios when we're doing our risk models, 75 to 80% of them show the potential for a positive return in the market.
So another easy one for you. What is your take? Fed was out just now. Powell didn't say a heck of a lot, but what is your take on all the background, all the current drama and factual issues, obviously, the Fed is dealing with right now, and how does that affect the way you're managing money?
It's a fair question. There's been a lot of debate around Fed independence, and it's valid to be asking it because there was an active White House employee that was appointed onto the Fed, and I think that and that person remains an active employee of the White House, and so you could see where the potential for questions around Fed independence can emerge, especially when the administration is advocating fairly publicly for much lower rates. But one thing that gives me comfort is that when I look at some of the folks that were, at least early on, considered contenders for the Fed chair position, despite some of the public rhetoric, it seemed like when it came time to actually voting in committee, they didn't seem to be joining in Steve Bannon's dissent in arguing for bigger cuts, and so for the most part, if you look at the composition and the number of dissents, have actually been fairly limited over the course of the last few meetings, and I think that shows that the spirit of independence for the Fed is still firmly in place. Now, there's a big question mark as to what happens post-May. So post-May, Chair Powell's term is up. There'll be a new chair in place, and so we'll have to see who that person is. But still, when I look at most of the people that are being considered today, I don't think that they're advocating for a really dramatic move in terms of rates downward, which I think is what would raise a lot of question around the future of independence. And keep in mind that in order to get a successful Fed chair in place, I think you have to have somebody who the bond market considers credible, and also somebody that can pass muster with the Senate. And so there's a little bit of a balancing act here that needs to happen that I think helps also to preserve that independence.
Great. Well, let's stay on the Fed for one more. Where do you see the Fed standing now on their dual mandates? And how is our Fidelity's proprietary employment model help you and help the team understand the labor side?
So, it's really interesting to see the transition that the Fed's undergone. So not too long, just a few years ago, we had really elevated inflation. In fact, at one point, CPI hit 9%. Clearly, in that type of environment, when the Fed is looking at their dual mandate of stable prices and full employment, that the pricing, the price component of it is going to really take center stage, and that was really their focus. Over time, as inflation started to come back in, post some of the normalization around supply shocks, post COVID, and some normalization of demand, we've seen inflation come back down. It's still running slightly elevated, slightly above where the Fed wants to see it. Remember, the Fed has targeted a 2% level of inflation when on a PCE basis. And it's been running closer to 3%. So we're still above it. But the way that I would characterize it is that it's not so far above it that it creates a dramatic concern. And so what we've seen over time is that there's been a shift, I think, in terms of their attention from inflation over to the labor market. And we've seen that in our data. So you mentioned our proprietary data. So Fidelity, we have a 13% market share in the 401k market. And that affords us really great access, really great insight into what's happening in the labor market, almost real time. So every 2 weeks, we get a pretty complete picture of how many companies are increasing their employment, how many are decreasing employees, and what the rate and what wages look like. And our data is representative of something like 40% of the U.S. manufacturing base and 20% of the U.S. banking and insurance system. So it's a really broad data set. And so what have you seen? We saw that we starting from a really strong starting point. the labor market over the course of the last 3 years or so has really softened. We've seen a lot less increases in labor, and more companies decreasing the amount of employees that they have on staff. And over the course of the last 18 months, it's been really what's been really notable is that when we look at our diffusion index, meaning when we compare how many companies are increasing employment versus decreasing, it's been roughly an even number. And in fact, it's dipped a little bit below zero, meaning that there have been a few more companies cutting back on jobs and adding. And so we've seen some weakness there. And I think that was one of the main drivers that drove the Fed to cut rates last year. Now, today, you mentioned we had today was Fed Day. The Fed opted to hold, which is exactly what the market had priced in. And interestingly enough, if you read through the statement, what you'll notice is that it reads a little bit hawkish. They firmed up their language, I think, around the employment picture, basically pointing out that labor's stabilized. They characterize the economy a little bit more strongly than they did in the previous statement. So it seems like maybe they're back to have seen a little bit of a tension between the two sides of the dual mandate. But my sense is that if we see weakness in the labor market, which I think is a little bit more likely than upward pressure and than a lot of upward pressure and inflation, I think that will take that will become the main focus of the Fed, and I think that that's what's more likely to help them to propel them to continue cutting at some point.
Well, let's just run with the idea on inflation. Repeat your feelings there, and we get a lot of questions on this. But do TIPS offer any value? And before we go into some of the positioning,
yeah. So when I look at the level of inflation, like I said earlier, I think it's running a little bit above the Fed's target, and I can make an argument that it could remain there for some time, but I have a really tough time making an argument that it will accelerate in any really meaningful way. Just given where we are with goods, given where we are with tariffs working their way through, and given where we're at with the state of the economy, I think it would be tough to see a big acceleration in inflation, particularly over the long term. And so if you look at the TIPS market, I like to look at 10-year TIPS and 30-year TIPS. Because when I look at those, I can see what is the market pricing in terms of long-term inflation, and then I can compare that to what our research analysts are projecting in terms of inflation, and look at all that great analysis and make a comparison. Do we think there's a gap between what the market sees and what we're seeing? And if you look at what the market's pricing in right now, actually for the last 3 years, 10-year TIPS and 30-year TIPS have been fairly consistent in a range of 2.2 to 2.4% inflation. That's not far off from where we are today. And so, meaning that it's hard for, and like I said, it's hard for me to see a really big acceleration longer term that's sustainable over a 10-year or 30-year period. And so I have a tough time seeing a lot of potential for capital gains in 10 and 30-year TIPS. Now, we have bought TIPS in the past, coming out of COVID when the market was pricing in a 1% inflation longer term or 1.5% inflation longer term. That to me seemed really attractive because I could easily make the argument that over time we would get back to 2.5% inflation longer term. And so at that point, we own 6%, a 6% position in TIPS in our portfolios. Today, it's basically zero because the upside potential relative to nominal treasuries, I think, is really limited given that the market's already pricing what I think is a reasonable amount of inflation over the long term.
So it works perhaps as a long-term, almost a hedge against inflation for endowments, foundations. You just don't see it as a viable relative value play in your funds.
Yeah, that's exactly right, Brian. Yeah, for me, I'm looking for a capital gain opportunity relative to nominals. And by the way, nominals I think offer some of the best risk reward in the market. And so I do think they're attractive. And if TIPS were offering a little bit more upside with respect to that inflation expectation, then sure, that would become a lot more attractive. But as a tail hedge, absolutely, it makes sense. The other way where it might make sense is if you have a really strong view on short-term inflation, and your expectation is that short-term inflation is going to outpace what's being priced into short tips, then that becomes a bit of a carry story, right? An income story there, and that could be attractive. It's just that for me, I in general would rather take a long-term view on inflation and make that the basis of the position in our portfolios.
So, Brian, we're going to switch over to you, my friend. One of best trades up in Merrimack, seemingly the last few years or so, has been taking a stance on the yield curve that it would normalize over time, and it's worked really well. Does that trade still have legs in relationship to what Celso's been telling us about the Fed and its intentions?
Yeah, exactly. We think so. This time last year, it was obviously a more obvious trade. So I think the low hanging fruit has been picked, but we still think there's some juice left in the trade. And so, while we've steepened a lot last year, if you zoom out and just look at the long term, average of the steepness of the curve, whatever metric you want to use, I think 2s, 10s is probably the easiest one to look at. We sit at 70 basis points today. So, that's a long way from where we were in 2023 when we were inverted by 100 basis points, but it's still below, the longer term average of 100 basis points. And so, while it might be a little less juice in the trade, we still think there's further room for steepening. And we think that's really going to be driven by, what Celso mentioned, and that's that pull lower in the front end. Again, if you look at market pricing, just looking at WIRP and Bloomberg, we have almost 2 cuts priced for the full year 2026. And also, what Celso mentioned with, the new Fed chair coming on, likely to be more dovish than Powell, potential, changes to the board composition, to have a more dovish lean. We think the front end is biased lower, over time. We also think the administration is likely to run, the economy maybe a little hotter here heading into the midterm. So this could bias the long end a little bit higher. And there's also, plenty of concerns about, funding the deficit that could push higher end yields higher as well. So from a positioning standpoint, we're still leaning, slightly long duration. We still believe in the steepener, and that's really done by owning a lot of treasuries in the belly of the curve, which we think will benefit from that front end moving lower. And I would just point out that, our alpha is really generated from security selection and sector. 10% of our alpha we would characterize, coming from duration and curve. So, there is alpha there, but it is a smaller portion, over a cycle than, our kind of bread and butter, which is the security and sector selection.
So somewhat of a relative overweight to our long-term positioning in government bonds. We've got less than the ag for sure, but the second largest component is the mortgage market, and then we're getting a lot of questions about Fannie and Freddie buying or planning on buying $200 billion in mortgages to lower interest rates. Can you give us our Fidelity's thoughts on that?
Yeah, sure. I mean, we're seeing obviously a lot of headlines, a lot of Truth Social posts, tweets, coming out of the FHFA and the administration. And, I think it's important to take everything with a grain of salt, sit back and see, what does this really mean? And so $200 billion in mortgages, what does that mean for the market? It's obviously a big headline grabbing number. But if you kind of take a step back, I think the 200 billion number was a little misleading. And so, if you look at the GSE activity over the past few months, starting kind of in the middle of summer, they had been purchasing mortgage loans and mortgage-backed securities to the tune of about 10 to 15 billion per month. And so if you just extrapolated that, buying that had been going on since the summer, that equated to about 150 billion of purchases. So, really the number we think the market should have been focused on was that incremental 50 billion of purchases. which was the increase from, I would say, the most of the street estimates, what they were expecting for the GSE's activity. And just to put the 50 billion in perspective, mortgage-backed security supply for 2025 was 1.2 trillion. The entire mortgage market is 10 trillion. So again, 50 billion in the grand scheme of things is really, pretty small in terms of the overall impact. That said, this headline did have a big move and a big impact on the market. And so if you look at, mortgage OAS, we tightened about 10 basis points on this headline alone. And a lot of that was driven by overseas buying. And so this announcement came out after the close. When we came in the next day, mortgages were already kind of ripping tighter. And so that really was surprising to us, and in gradual, contrarian fashion, which we like to run our funds, we took the other side of that. We felt the move was overdone. We sold into the strength. And I think we saw a lot of our competitors as well, money managers, selling into this strong bid, given the moves. And since then, we've kind of backed up off of those local tights. So I would say we've given about half of that tightening back, since that move. The other point I would make is, what did this do to the mortgage rate? It's a lot of headlines. It's a big number. Did it actually impact the mortgage rate? The mortgage rate went from 6 1/8, the conforming 30-year mortgage rate from 6 1/8 to 6. So it moved at about 1/8 of a point. Not very much in the grand scheme of things. And I think if you look at the mortgage rate today, we're actually above 6 1/8. So we've kind of given all that back. The one last point I would just make is just the difference between the Fed buying and the GSE buying. And so when the Fed was buying, they were buying production coupons, and they were basically taking out the supply and all the vol. So it was basically this double whammy that had this larger impact on the mortgage rate than the GSEs. The GSEs will be hedging the vol and the convexity. So not as much impact coming from the GSE purchases as the Fed.
So with that background, mortgage spreads are tight. You just sold some into the bid, basically. Where are you finding value? Credit's tight. Investment grade credit, basically historical tights, right? Where are you finding value in good carry or income in the current environment?
Yeah, Brian, I'm not going to lie. It's getting tough out there. Every sector feels like it's reaching new tights every day. The thing that my teammates, remind me of every day is we need to be patient. Returns in fixed income are episodic. We're not in one of those episodes right now. Yields on treasuries are attractive, and there will be an opportunity to buy credit. That said, we do maintain a modest carry advantage in the funds, and where we're finding, more attractively priced opportunities without taking, incremental risk is really in the non-agency securitized market. So specifically, that's ABS, CMBS, and CLOs. And so I would say, what we own in those markets is very different than what you see in the ag. So generally in ABS, in the ag, it's mostly cards and autos. What we own is more esoteric and offers greater, return potential. So a couple areas we like in ABS or aircraft ABS. I think we're really uniquely positioned at Fidelity, given our resources to cover that space. We have a structured analyst that really dives into the structure, understands the protections, and he partners with our aircraft analyst who covers all the airlines, the air lessors. And so we have a good picture into not only the structure, the collateral, the marketplace, and can really dive in, on the relative value. So that's one space we like. The other space we like in ABS is whole business franchise. And so these are names like Domino's, Dunkin', Jersey Mike's, and the deals are collateralized by the royalty fees. So that's basically your 5 to 6%, right off the top. And so we really like the structures on the deals. We like the strong cash flow profiles, and we think we're getting paid to play in these things. The other two markets, I would just say, in CLOs, again, not in the ag, it's a 144A market, but it's the US BSL market is approaching $1 trillion. So it's an extremely large market, extremely liquid. The investor base is growing, and there's really attractive yields and returns we can get there. at the top of the capital structure. So plenty of downside protection. AAAs have never taken a loss, not even in the GFC. And we're getting incremental yield to own these. And then the last part is the CMBS market. And so again, if you look what's in the ag, it's mostly agency CMBS and conduit. Where we're finding a lot of value is in the single asset, single borrower part of the market, also known as the SASB market. And again, we're really able to dig in and find investments in different property types. We have a great team in Merrimack, both on the securitized side, the REIT side. We have a high yield team down in Boston that's looking at these deals towards the bottom of the capital structure. They're often visiting these properties. And so, again, from a coverage standpoint, from a research standpoint, this is really where we can find idiosyncratic opportunities kind of across the capital structure for our funds.
So real quick, and then we're going to wrap up with Celso. Bond flows have been positive for since 22, let's just say. And we don't need necessarily money market flows to fuel that. Can you give us what do you guys see as the biggest catalyst for the growth in the bond market?
Sure. I mean, I think Celso hit it on the head when he talked about how attractive yields are and the ballast it can add to the portfolio. I talk to the money market team all the time. I go down there, I ask when the flows are coming out of money markets into bonds. No one has the answer to that. We don't have a crystal ball. Again, I think as the yield curve continues to steepen, you will see some of that movement out the curve. But bond flows have been positive, regardless of money market and cash being sticky. If you just look at the cash that's being thrown off by the ag that needs to be reinvested, it's almost $100 billion a month. And so the technicals are really strong in the bond market. Flows have been positive last year, and I think that will continue to be the case as people diversify into bonds and really want that ballast in their portfolio. So I'm optimistic about the bond market, about flows, and I don't know when the money market flow will happen into bonds. But, the last point I would make is that if you're looking at that for a sign to move in a bond, it's already too late. We think the opportunity is today. We think bonds are attractive. And we wouldn't be looking at money market flows into bonds as a sign to move into bonds. We think that time is now.
I don't know any better way to finish it off than what you just said. So I'm going to leave it at that. Thank you for all in the audience. And especially thank you to our speakers here for sharing your expertise. And again, thank you for taking time with us for the inaugural session of this. And I'm right on the half hour, Mike. So thank you all for attending.